2025 is not just a year, it's an opportunity. It's a chance to finally take control of your financial destiny and build wealth that not only lasts but grows exponentially. If you're watching this video, then you're already taking that first crucial step towards financial freedom. But here's the truth. This isn't going to be easy. And it's certainly not going to be like anything you've heard before. The conventional advice that you've probably been fed for years? It's outdated. Stop thinking that buying random stocks or betting on cryptocurrency is your ticket to success. That's gambling, not investing. And that's where most people get it wrong. If you truly want to achieve wealth, to create a life where money is not a worry, but a tool to amplify your freedom and choices, then you need a strategy. You need to understand what assets will actually generate lasting wealth, and not just short-term gains. The difference between those who achieve financial freedom and those who are always chasing it boils down to one key factor: diversification. But not just any kind of diversification, smart diversification. In this video, I'm going to reveal 5 powerful assets that, if you know how to use them, will help you not just survive, but thrive in the financial world of 2025 and beyond. These are the types of assets that will protect you when the market crashes, multiply your wealth over time, and create income streams that will work for you, whether you're asleep, on vacation, or pursuing your dreams. But let me warn you, this isn't some cookie-cutter advice where I tell you to follow the herd. If you want to see real success, you need to break away from the crowd and make smarter choices. As we go through these assets, I'm not just going to throw a bunch of technical jargon at you. I'm going to explain why each asset matters, how it fits into a larger wealth-building strategy, and how you can begin implementing these in your own life right now. Plus, I'll share real-life examples and success stories from people who have used these exact strategies to go from ordinary to extraordinary in their financial journey. But here's the catch. It's not enough to just know about these assets. You need to understand them, you need to internalize them, and you need to adopt the right mindset to succeed. So, before you dive into these 5 game-changing assets, ask yourself, are you truly ready to make the shift? Are you prepared to stop looking for quick fixes and start playing the long game? Now, let's talk about the assets that can change everything for you. These assets will diversify your portfolio and shield your wealth when times get tough. They will allow you to take control and build multiple streams of income that you can count on, no matter what happens in the market or economy. By the end of this video, you won't just walk away with a list of assets to buy. You'll have a blueprint for how to strategically build your wealth in a way that fits your goals, your risk tolerance, and your life vision. And I promise you, this is the kind of financial freedom most people only dream about. So, stick with me until the end. I'm going to break it down in a way that's simple to understand, but powerful enough to change your future. No fluff, no filler, just real, actionable steps. Let's dive in. Are you ready to start building the future you deserve? Let's go. 1. Paper assets, the stock market. When we think about building wealth, paper assets are typically the first thing that comes to mind, and for good reason. Paper assets, such as stocks, bonds, and mutual funds, are the backbone of most investment portfolios. However, many investors make a crucial mistake. They approach the stock market like a game of chance, hoping to pick a winner. The truth is, successful wealth building isn't about finding the next big stock. Instead, the key lies in investing in a way that gives you exposure to the entire economy. This is where exchange-traded funds, ETFs, come into play. ETFs are investment funds that pull together a variety of assets, allowing you to invest in a broad range of companies or sectors. Take, for example, VTI, an ETF that tracks the entire US stock market, offering exposure to hundreds of companies across different industries. It's like owning a piece of the entire US economy. Another popular ETF is SPY, which mirrors the performance of the S&P 500, representing the 500 largest companies in the US. The beauty of ETFs is that they provide diversification, so even if one company struggles or goes bankrupt, the impact on your investment is minimized because the risk is spread across hundreds of companies. Over the years, I've watched countless investors chase after the next big stock, hoping for quick returns, but I've learned that successful investing isn't about timing the market or betting on individual companies. It's about making consistent investments in broad-based funds like ETFs that track the market as a whole. One strategy I've adopted is called, always be buying, and here's why it works. The stock market can be volatile, it fluctuates up and down. The key is not to get caught up in short-term price changes. Panic selling during market dips is one of the biggest mistakes investors make. I've experienced market crashes myself, from the 2008 financial crisis to the COVID-19 crash in 2020. Each time, the temptation to sell was strong, but I stuck to my strategy of consistent buying. I set up an automatic investment plan that purchased shares of ETFs like VTI and SPY every week. No matter what, it didn't matter whether the market was high or low, I kept buying. Here's the magic behind this approach: by buying regularly, you're actually purchasing more shares when prices are low and fewer shares when prices are high. Over time, this smooths out the impact of market volatility and allows you to accumulate assets at more favorable prices. This strategy is known as dollar cost averaging, and it's a powerful tool for long-term wealth building. When the market drops, it's actually a buying opportunity. Stocks and ETFs go on sale, and by continuing to invest regularly, you position yourself to benefit from the market's long-term growth. Consider this: if you had invested in SPY 10 years ago, right after the 2008 financial crisis, the market was down, but you kept buying each month. Fast forward to today, and SPY has seen significant growth. Your consistent investments during the downturn would have grown exponentially as the market recovered. The point is simple: you don't make money by trying to time the market, you make money by staying in it. For many people, the idea of buying during a market drop feels counterintuitive. Most would prefer to wait until they see signs of growth before jumping in. But here's the reality: if you wait until the market is up, you're already too late. Consistently investing over time allows you to ride out short-term volatility. And as the market tends to rise in the long run, your investments will grow with it. Another key benefit of investing in ETFs like VTI or SPY is the instant diversification they provide. Instead of putting all your money into one stock or sector, you're spreading your risk across hundreds of companies. This way, if one company struggles, the others help buffer the impact. It's the most efficient and safest way to manage risk while still gaining access to the overall growth of the economy. If there's one piece of advice I give to new investors, it's this: don't waste time trying to pick individual stocks based on trends or trying to time the market. Instead, focus on the bigger picture. Keep it simple. Invest in broad-based funds, like ETFs, that track the whole market. Invest consistently, and let time work in your favor. That's the secret to building real wealth. In conclusion, investing in paper assets, especially broad-based funds like ETFs, gives you the chance to capitalize on the growth of the stock market without the risk of individual stocks. By sticking to a strategy of consistent, long-term investing, you're setting yourself up for wealth that's built on stability and growth. Focus on the bigger picture and remember, always be buying. This is the path that the most successful investors take to build lasting wealth over time. 2. Hard assets, real estate. Real estate is often considered the cornerstone of wealth building. And for good reason. Unlike paper assets that exist on paper, real estate is tangible. It's something you can touch, feel, and even live in. And here's the exciting part: real estate can generate income for you. It's not just about buying a home to live in, it's about buying properties that generate passive income month after month. Putting money in your pocket while you sleep. This is where the true power of real estate lies. The key here is understanding that not all real estate is created equal. Many people fall into the trap of thinking that buying a house to live in is the best investment. The truth? That's actually a liability, not an asset. Your primary residence is an expense, it's where you live, not where you make money. Instead, rental properties are where the magic happens. Rental properties are not just homes, they are income-generating assets that pay you consistently. Let me share a real-life example from my own journey. A few years ago, I purchased a rental property for $200 in a growing city. The area was on the rise, and there was steady demand for rental units. I found a great tenant, and the monthly rent came out to $2,100. At first glance, this may seem like a great deal. However, there are always expenses to account for. After factoring in property management fees, maintenance costs, taxes, and insurance, my net profit was around $14,200 per year. That's a 7% return on investment, ROI, which is impressive, especially when you compare it to the returns you might get from stocks or bonds. But here's the thing. The income from rent is only part of the story. Over time, the property appreciated in value. What started as a $200 investment eventually became worth more, increasing my wealth not only through cash flow but also through capital appreciation. This is the beauty of real estate. Not only are you making money every month through rent, but your asset is also increasing in value over time. And when you factor in the power of leverage, where you borrow money to buy a property, rather than using all your own capital, you can multiply your returns significantly. In real estate, your equity grows as you pay down the mortgage, and that equity becomes your net worth. This dual benefit of income and appreciation is what makes real estate such a powerful wealth-building tool. However, I understand that not everyone has $200,000 lying around to buy a property. And that's perfectly fine. Real estate investing doesn't require you to go all in on a single property. If you're not ready to commit that much capital, there are alternatives that still allow you to tap into the power of real estate. One option is real estate crowdfunding, which allows you to pool your money with other investors to fund larger real estate projects. This way, you can invest in properties or projects you wouldn't be able to afford on your own. Another option is REITs, real estate investment trusts, which are companies that own and manage real estate portfolios. By buying shares in a REIT, you gain exposure to the real estate market without needing to directly own property. REITs typically pay dividends, which means they provide regular income, similar to rental properties. This makes them an excellent option for those who want to start building wealth in real estate without having to deal with the complexities of property management. For example, one of the most successful real estate investors I know started with just $10 in REITs. Over time, that investment grew through consistent dividends and reinvestment. While REITs don't give you the same hands-on experience as owning physical properties, they offer liquidity and flexibility. You can invest in them without needing to deal with the hassle of finding tenants or maintaining a property. Now, here's my personal insight. Real estate is a long-term game. You don't get rich overnight with real estate. But over time, if you remain consistent, your investments will grow and pay off. The key is to get started. No matter how small the investment is, the first property or REIT investment you make might not make you a millionaire tomorrow. But it's the first step toward building real wealth. If you wait until you have enough money for a $200 rental property, you may never take that first step. The best time to start investing in real estate was yesterday. The second best time is today. In conclusion, whether you're investing in physical rental properties, real estate crowdfunding, or REITs, real estate offers an incredible opportunity to build wealth through passive income and capital appreciation. By investing in the right way and with a long-term mindset, real estate can become one of your most powerful wealth-building tools. So, if you haven't already, start exploring the real estate market today. Your future self will thank you. 3. Protection assets, gold and precious metals. When it comes to building wealth and protecting your hard-earned assets, protection assets like gold and other precious metals play an essential role in diversifying your portfolio. These assets are often referred to as safe haven investments because, unlike stocks or bonds, they tend to hold their value or even appreciate during times of economic uncertainty or market downturns. While paper assets like stocks or ETFs are highly susceptible to market volatility, gold doesn't need active management or frequent updates. It is inherently a store of value. It's been considered a form of money for thousands of years. And throughout history, people have turned to gold during periods of financial crisis, inflation, or geopolitical instability. This is because, no matter what happens in the global economy, gold's intrinsic value remains largely unaffected. Now, let's break this down further. Think about the past several decades. We've seen periods of economic boom, followed by sudden financial crises, such as the 2008 global recession, and even the financial chaos caused by the pandemic. During these times, while the stock market may have taken a nosedive, gold often saw its value increase. Why? Because people flock to gold as a safe asset when confidence in paper currencies and markets weakens. For example, let's take a look at the price of gold during the 2008 financial crisis. While the stock market was in freefall, gold prices surged from about $800 an ounce to over $1.200 an ounce by 2012. Those who held gold during this period didn't just protect their wealth, they grew it. From my personal experience, I keep a small but significant portion of my portfolio in gold, not because I expect it to make me rich, but because it offers stability in an otherwise unpredictable world. Gold doesn't have the same dramatic swings that stocks might have. And that's exactly why I love it. It's not about chasing high returns in a short period of time. It's about ensuring that when everything else is up and down, gold remains a constant in my portfolio. Here's an example to illustrate why I think gold is a key asset in any investor's strategy. Imagine you buried $10 in cash and $10 worth of gold in your backyard today. Let's fast forward 10 years. You dig them both up. What do you think you'd find? The cash would have likely depreciated due to inflation, meaning its purchasing power has decreased over time. However, the gold? It would probably have more purchasing power today than it did when you buried it. That's because gold acts as a hedge against inflation, meaning it can protect your wealth from the erosion of the dollar's value over time. Let me give you another example that brings this point to life. I know an investor who purchased gold coins in the early 2000s for about $300 per ounce. Fast forward to today, and the price of gold has risen above $1.800 per ounce. That's more than a 500% increase over 20 years. And that's not even factoring in the inflation during that time. What's more interesting is that during that entire period, the investor's gold holdings were able to withstand all of the market crashes and economic upheavals. From the 2008 recession to the financial turmoil we saw in 2020. While many other assets lost value during these turbulent times, gold stood strong. Gold isn't just about price appreciation, though. It's about security. When the stock market drops dramatically, gold often stays stable or even increases. Precious metals like gold, silver, and platinum provide a buffer against the volatility of traditional financial markets. That's why, in times of crisis, whether it's a recession, market crash, or political instability, gold and precious metals are usually the go-to choice for savvy investors seeking peace of mind. You don't need to allocate a huge portion of your wealth to gold. 5 to 10% of your total portfolio is a great starting point. But this small percentage can make a huge difference in protecting your wealth and ensuring that your portfolio is insulated from the worst-case scenarios that might hit traditional markets. Over time, this small allocation could serve as your financial insurance, helping to preserve your wealth through any storm. In conclusion, while gold and other precious metals may not make you rich overnight, they certainly offer a level of protection that no other asset class can provide. It's not just about the price fluctuations, it's about ensuring that your money maintains its value in an ever-changing financial landscape. When everything else seems uncertain, gold remains a reliable and powerful hedge against inflation, currency devaluation, and market crashes. By incorporating a portion of protection assets like gold into your investment strategy, you're not just protecting your wealth, you're setting yourself up for long-term success in uncertain times. 4. Speculative assets, cryptos, startups, and collectibles. When it comes to wealth building, there's an exciting and often controversial category of assets called speculative assets. These are the types of investments that carry high risk but, if timed correctly, can yield massive returns. Speculative assets include things like cryptocurrencies, startups, and even collectibles such as art, vintage watches, or rare memorabilia. The key to understanding speculative assets is recognizing that while they have the potential for tremendous growth, they can also be incredibly volatile and unpredictable. Let's talk about one of the most talked about speculative assets in recent years, cryptocurrency. The rise of Bitcoin, Ethereum, and countless altcoins has turned the world of digital currencies into a global phenomenon. I still remember when I first bought Bitcoin years ago, back when it was under $500 per coin. At that time, many people thought it was just a fad. Fast forward to today, and Bitcoin has reached prices well above $60 at its peak. For anyone who held onto their investment, That's an incredible return on their money. But here's the flip side. As much as cryptocurrency has the potential to skyrocket, it's also subject to wild price fluctuations. In just the past few years, we've seen Bitcoin drop from over $60 to under $30, and sometimes even lower. This volatility is what makes cryptocurrency a speculative asset. It's not for the faint of heart. There are days when you could see your investment surge, and then just as quickly, witness those same investments take a significant dive. I've personally experienced this roller coaster ride, and while I've made money, I've also seen my fair share of ups and downs. That's why when it comes to speculative investments, I always emphasize caution. I allocate only 10 to 15% of my portfolio to speculative assets. And I make sure that this money is above and beyond my foundational investments in things like real estate, stocks, and gold. These foundational assets provide me with stability and protection, and speculative investments come in as the potential cherry on top. Another area where speculative assets can play a role is in startups. Investing in a promising new company can offer incredible rewards, especially when you're getting in early. Think about companies like Uber, Airbnb, or Tesla, which all started as startups. Those who invested in these companies early saw exponential growth as they became industry giants. However, it's important to remember that for every Uber or Tesla, there are countless failed startups. Most new businesses don't make it, and many investors end up losing their money. That's why startup investing requires a great deal of research, due diligence, and, most importantly, patience. I have a few startup investments in my portfolio, but I don't treat them as the core of my wealth building strategy. They are high risk, but if the company takes off, the returns can be transformational. However, if the company fails, the money can be gone in an instant. So, you have to approach startup investments with a mindset that is prepared for both outcomes. Then, we have collectibles, a space that has grown exponentially in recent years. Think about high-end watches, art, or even rare sports memorabilia. These items are considered speculative because their value can fluctuate significantly depending on demand, trends, and even public perception. I personally know a few people who have made substantial profits by investing in luxury watches like Rolex or vintage artworks. What's interesting about collectibles is that they combine both tangible assets and speculative risk. You're not just betting on market trends, you're also betting on the perceived value of something that may be emotionally prized by collectors. For example, a rare Picasso painting or a vintage Ferrari can appreciate over time due to their scarcity and historical significance. But, like any speculative investment, you need to have an eye for what will hold value in the long term. It's not just about buying something because it's trendy today. It's about buying with the foresight to understand what will still be valuable decades from now. As I mentioned earlier, speculative investments can be incredibly rewarding, but they come with significant risk. It's easy to get caught up in the excitement of seeing big returns. But the key is to keep perspective. I don't put all my wealth into speculative assets. I keep them as a small portion of my portfolio, knowing full well that some of these investments may pay off, but others may not. One thing I've learned is that while speculative assets can make you rich, they can also drain your wealth if you're not careful. You have to approach these investments with a clear strategy, a disciplined mindset, and most importantly, the understanding that not every investment will be a home run. High risk can lead to high reward, but only if you're calculated and strategic in your approach. In conclusion, speculative assets like cryptocurrencies, startups, and collectibles are a great way to potentially multiply your wealth, but they are also highly volatile and require a careful approach. Keep them as a part of your portfolio, but always remember to balance them with safer, more stable assets. The best investors know how to combine risk with caution, and it's this approach that will allow you to build long-term wealth while still taking advantage of the exciting opportunities that speculative assets present. 5. Income-producing assets, passive income streams. Income-producing assets are the cornerstone of creating a sustainable wealth-building system, and they are absolutely essential for anyone serious about achieving financial freedom. These assets are exactly what they sound like. They generate regular cash flow, allowing you to earn money passively. This type of income doesn't require you to trade your time for money each day. Instead, it's about making your money work for you. not the other way around. Let's take a closer look at some classic examples of income-producing assets. One of the most straightforward options is investing in dividend-paying stocks. When you invest in a company that pays dividends, you're essentially receiving a portion of the company's profits on a regular basis. For example, if you invest in a stock that offers a 5% annual dividend, you're earning 5% of your investment each year, simply for holding the stock. Over time, this can add up significantly, especially when you reinvest those dividends to grow your portfolio. Another prime example of income-producing assets is rental properties. Real estate offers the opportunity to generate consistent rental income every month, providing you with cash flow that can be used to fund your lifestyle or reinvest into additional properties. I know many investors who have built substantial wealth through a portfolio of rental properties, and they swear by it. The key is choosing properties in high-demand areas to ensure that your properties remain occupied and generate steady income. But what about businesses? While many people believe that building a business requires massive investments of time, energy, and capital, it's possible to create a cash-flowing business with a relatively low initial investment. I'm a great example of this. I started Minority Mindset with minimal upfront costs, just a small tripod and a light for creating videos, and a lot of hard work. I reinvested the modest profits I made, and over time, I built a business that generates consistent cash flow. Now, that cash flow is used to fund more investments, continuing the cycle of wealth growth. The key is creating a system where your business or investment income fuels future investments, further expanding your wealth. Personal insight. The beauty of income-producing assets is that they can be built with relatively little capital, and they have the potential to scale over time. One of the first steps I took toward building wealth was focusing on businesses that could generate income without requiring my constant attention. It wasn't about working more hours or putting in more effort. It was about creating something that would continue to generate cash flow even when I wasn't actively involved. For example, I built online systems for content creation and marketing that allowed my business to run automatically. This is one of the keys to building financial freedom, creating businesses that work for you, even while you sleep. Another excellent way to start building income-producing assets is by investing in high-dividend stocks or real estate investment trusts, REITs. These options allow you to earn passive income from stocks or real estate without the headache of directly managing properties. REITs, for example, let you invest in real estate properties and receive dividends from the rents those properties generate. It's a fantastic way to add passive income to your portfolio without having to buy or manage real estate yourself. I have a friend who started investing in high-dividend stocks in his early 20s. He didn't have much capital to begin with, but he understood the power of compound interest and dividend reinvestment. By carefully selecting stocks with a track record of paying reliable dividends, he grew his portfolio significantly over time. What's even better is that he doesn't need to sell his stocks to realize a return. He simply collects the dividends every quarter. This steady stream of passive income gave him more financial freedom and allowed him to fund his next investments. The real power of income-producing assets is not only in wealth creation but also in financial security. Whether it's from rental income, dividends, or business profits, the more of these assets you have, the less reliant you are on a traditional job or salary. The goal is to build multiple streams of income, each supporting the others. This creates stability, especially during times of economic downturn or uncertainty. If you're truly committed to building wealth, I encourage you to focus on acquiring businesses or investments that generate regular cash flow. This could mean investing in dividend-paying stocks, starting your own online business, or purchasing rental properties. The key is consistency. By continually reinvesting your profits into more income-generating assets, you'll build wealth more quickly and sustainably. Ultimately, it's about creating a self-sustaining system where your money works for you, not the other way around. Income-producing assets are the pathway to true financial freedom. They allow you to live the life you want without constantly trading your time for money. And remember, the earlier you start, the greater the potential for these assets to grow and support your lifestyle for years to come. As we wrap things up today, let's take a moment to reflect on the core principles that can truly set you up for success in your wealth-building journey. Building wealth isn't about luck. It's about making smart decisions and embracing the power of diversification. The richest individuals and the most successful investors understand this key principle. A balanced approach to investing is crucial. By focusing on paper assets, hard assets, protection assets, speculative assets, and income-producing assets, you create a portfolio that's not reliant on one single asset class or market condition. Each type of asset has its own unique role to play. Paper assets like stocks and bonds allow you to grow your wealth through the performance of the overall market. But they also carry the risk of volatility. That's why it's important to pair them with hard assets like real estate, physical properties that provide not only appreciation but also passive income from rent. And, of course, protection assets like gold safeguard your wealth, especially during uncertain times when markets can shift unexpectedly. Speculative assets, like cryptocurrencies or startups, give you the chance for high returns. But you've got to approach them with caution, knowing the risks involved. Finally, income-producing assets, like dividend-paying stocks or rental properties, offer that consistent cash flow that can support your lifestyle and help you reinvest to grow your wealth further. The key takeaway here is that diversification is your best defense. By spreading your investments across different types of assets, you create a safety net that shields you from the unpredictable nature of the market. Don't put all your eggs in one basket. This old saying is one of the fundamental principles of successful investing. When one asset class is down, another may be up. And that's the balance you need to build long-term wealth. Consistency is also critical. As we discussed earlier, the strategy of always be buying doesn't just apply to stocks, it applies across the board. Whether it's real estate, cryptocurrency, or income-producing assets, make it a habit to consistently invest. By doing so, you take advantage of both market highs and lows, ensuring that you're always accumulating valuable assets. The beauty of this strategy is that you don't have to time the market perfectly. You simply commit to the process and let time and compounding do the work for you. As you go forward, think of this as a long-term game. Wealth building doesn't happen overnight. It takes time, patience, and a strategic approach. It's about making choices today that will pay off years or decades down the road. And just as importantly, it's about developing the discipline to stay focused on your goals and not be swayed by short-term noise or distractions. So, where do you start? If you're new to investing, start small. Focus on building your foundation with stable assets like ETFs or real estate. Gradually, as your wealth grows, you can start exploring other areas like cryptocurrencies or startups. It's all about building momentum, step by step. And, most importantly, always remember to keep your long-term goals in mind. I'd love to hear from you. What assets are you excited to start investing in today? Drop your thoughts in the comments below. Remember, there's no one-size-fits-all approach to investing, and your journey will be unique to you. But by applying these principles of diversification, consistency, and patience, you're already on the right path. If you found value in today's video, do me a favor and hit that like button to let me know. Subscribe to the channel so you don't miss out on future videos. And turn on notifications so you can stay updated on all the latest tips and strategies for building wealth. This channel is dedicated to helping you unlock your financial potential, and I'll be right here with you every step of the way. Thank you so much for watching, and I'll see you in the next video. Keep pushing forward, stay focused, and remember, wealth building is a journey, not a sprint.